What if the price of silver, one of the world's most historic stores of value, isn't moving purely on supply and demand? What if the forces shaping its price are far more concentrated, structured, and strategic than most investors realize? Today, we're going to examine the structure of the silver futures market, the documented enforcement cases, and the data patterns that continue to raise serious questions. This is not speculation. This is market structure, regulatory history, and verifiable financial evidence. Most investors believe silver prices move because mines produce less metal or because industrial demand rises. That assumption sounds logical, but it does not fully reflect how modern price discovery actually works. The benchmark price of silver is primarily formed in the futures market, operated by the Chicago Mercantile Exchange through its COMEX platform. This is where large financial institutions, hedge funds, commercial hedgers, and speculators transact standardized contracts representing future delivery of silver. The critical detail many overlook is that these contracts are financial instruments first and physical delivery mechanisms second. On any given trading day, the volume of silver futures contracts exchanged can represent hundreds of millions of ounces, yet only a small percentage of those contracts ever result in physical delivery. Most are offset, rolled forward, or closed prior to expiration. This means the price investors reference globally is heavily influenced by financial positioning, liquidity flows, margin requirements, and risk management decisions rather than immediate changes in refinery output or bullion shortages. This structure creates a market where capital flows can dominate fundamentals in the short term. When large participants increase short exposure, reduce risk, or rebalance portfolios, their activity can move price significantly, even if nothing has changed in global mine supply or industrial consumption. Futures markets are designed for hedging and price efficiency, but they also introduce leverage. A relatively small amount of capital controls a much larger notional exposure, amplifying both upward and downward price swings. It is important to clarify that this structure is not inherently improper. Futures markets exist to provide liquidity, allow producers to hedge output, and enable price discovery. However, understanding that price formation is financialized changes how one interprets volatility. Sharp moves may reflect position adjustments, algorithmic triggers, or macroeconomic risk sentiment rather than physical tightness. If you are analyzing silver purely through supply-demand spreadsheets, without monitoring futures open interest, positioning data, and liquidity conditions, you are only seeing part of the equation. The modern silver price is not determined at the mine or refinery. It is determined on a derivatives exchange where financial strategy often leads and physical metal follows. At first glance, the silver market appears straightforward. Buyers and sellers exchange metal, and price adjusts accordingly. But when you examine the structure beneath the surface, a more complex dynamic emerges. The volume of paper silver, futures contracts representing silver, routinely exceeds the amount of physical silver registered and available for delivery on COMEX warehouses. That imbalance is not a rumor or exaggeration. It is visible in publicly reported open interest and inventory data. Open interest represents the total number of outstanding futures contracts. Each contract controls a fixed quantity of silver. When you aggregate those contracts, the notional exposure can reach multiples of the physical inventory, categorized as deliverable. This does not mean all contract holders will demand physical metal. In reality, most contracts are closed or rolled before expiration. However, the leverage embedded in this system allows significant price influence without requiring proportional physical supply. This structure transforms silver into a highly financialized asset. Capital efficiency becomes the dominant force. A participant can control substantial exposure with a fraction of the notional value through margin requirements. When large traders adjust positions, whether increasing shorts, reducing longs, or reallocating risk, price reacts to those flows. The move may have little connection to mine production, industrial usage, or retail bullion demand at that moment. The key financial insight here is not that paper contracts are inherently problematic. Futures markets are essential for hedging and liquidity. The issue is scale and ratio. When derivative exposure substantially outweighs deliverable inventory, price sensitivity shifts toward financial positioning rather than physical constraints. In such an environment, liquidity events, macroeconomic data releases, or risk-off sentiment can trigger significant volatility independent of warehouse supply levels. This also explains why periods of strong retail demand, such as rising premiums on coins and bars, do not always translate into immediate futures price spikes. The futures market reflects aggregated financial exposure first. Physical tightness may influence price over time, but short-term direction is often driven by leverage dynamics. For investors and analysts, ignoring this imbalance can lead to misinterpretation. Silver is not priced solely by scarcity. It is priced within a leveraged derivatives framework where capital flow, margin pressure, and institutional positioning frequently outweigh physical availability in the near term. When discussions about silver market integrity arise, skepticism often follows. Markets are regulated, exchanges are monitored, and large institutions operate under compliance frameworks. That is precisely why documented enforcement actions matter so much. They shift the conversation from suspicion to verified legal findings. In 2020, traders at JP Morgan Chase were charged with engaging in spoofing within precious metals futures markets, including silver. Spoofing involves placing large orders with no intention of executing them, designed to create a false impression of supply or demand and influence short-term price movement. This was not a theory debated online. It was a case pursued by regulators and resolved with substantial financial penalties. Oversight responsibility falls to the Commodity Futures Trading Commission, which monitors U.S. derivatives markets for abusive trading practices. Enforcement records show that manipulation in futures markets is not hypothetical. It has occurred, it has been investigated, and it has resulted in fines and legal consequences. For serious investors, that fact alone demands attention. It demonstrates that even in highly regulated financial environments, distortive behavior can temporarily influence price discovery. The financial implication is not that every price decline or rally is manipulation. That would be analytically careless. Instead, the key insight is structural vulnerability. Futures markets are fast, leveraged, and electronic. Large visible orders can impact sentiment and trigger algorithmic responses within milliseconds. When spoofing occurs, it can create artificial momentum, induce other participants to react, and amplify short-term volatility before orders are withdrawn. This matters because price discovery in silver primarily occurs in the futures market. If improper trading practices distort order books, even briefly, they can influence benchmark pricing that ripples globally. The existence of enforcement cases confirms that market structure can be exploited when controls fail or are intentionally bypassed. For financial professionals, the takeaway is not outrage, but awareness. Regulatory history provides documented evidence that misconduct has taken place in precious metals derivatives. That evidence reinforces the importance of analyzing order flow, monitoring positioning data, and recognizing that price movement in leveraged markets can occasionally reflect strategic behavior rather than purely organic supply-demand interaction. In every financial market, concentration matters. When a small number of participants control a meaningful share of total positioning, their decisions carry disproportionate weight. In the silver futures market, regulatory data at times has shown that a limited group of large commercial traders hold significant short exposure relative to total open interest. This is not hidden information. It is reflected in publicly available commitment of traders' reports and position concentration metrics. The immediate question investors should ask is simple. What happens when a handful of institutions control a substantial portion of directional risk? Even if those positions are established for legitimate hedging or balance sheet management purposes, scale alone introduces influence. Large short positions require ongoing margin management, liquidity access, and strategic timing. Adjustments to those positions, whether covering, expanding, or rolling forward, can move price, particularly during periods of thin liquidity. It is important to remain precise. Concentrated positions are not illegal. Commodity producers and financial intermediaries often hedge exposure using futures contracts. However, concentration increases market sensitivity. When positioning is widely distributed across thousands of participants, price discovery tends to reflect a broader consensus. When exposure is clustered among a few dominant entities, shifts in their risk tolerance can create outsized price reactions. This dynamic becomes more visible during rapid sell-offs. If a concentrated short position is actively defending or expanding exposure, the scale of orders required can influence order book depth and trigger algorithmic responses. In leveraged futures markets, momentum can build quickly. Other traders may interpret large sell orders as informational signals, accelerating the move without fully understanding the underlying motive. From a financial analysis perspective, the key issue is systemic influence rather than intent. Market structure allows concentrated exposure to shape volatility patterns. That does not confirm coordinated suppression, nor does it imply wrongdoing. It simply acknowledges that scale alters impact. When assessing silver price movements, ignoring concentration data means overlooking a variable that directly affects liquidity dynamics, short-term momentum, and overall market stability. If you still think silver trades the way it did 20 years ago, you are analyzing the wrong market. Today's silver futures environment is dominated by electronic execution and algorithmic trading systems that operate at speeds no human can manually match. Orders are routed, modified, and canceled within milliseconds. In this structure, price movement is not just a reflection of human conviction, It is increasingly the outcome of programmed strategies reacting to liquidity, volatility, and momentum signals. Silver futures trade nearly around the clock, but liquidity is not constant throughout the day. During off-peak hours, particularly when major financial centers are closed, order book depth can thin out significantly. In these conditions, relatively large sell programs can move price sharply. Once a decline begins, algorithms designed to follow momentum or trigger stop-loss levels can amplify the move. What starts as a liquidity-driven push can cascade into a rapid, exaggerated price swing. This phenomenon does not require new supply data, mining disruptions, or industrial demand shifts. It can occur purely within the market microstructure of leveraged derivatives trading. Because futures contracts require margin rather than full capital outlay, participants control significant notional exposure with comparatively small cash commitments. That leverage magnifies the impact of forced liquidations when volatility spikes. Margin calls and risk controls can trigger automatic selling, reinforcing downward pressure independent of physical fundamentals. The critical insight is that electronic structure changes the character of volatility. Sharp intraday declines are sometimes interpreted as evidence of sudden negative information about silver's underlying value. In reality, they may reflect liquidity gaps, algorithmic execution, or systematic de-risking across broader asset classes. Silver often trades in correlation with macroeconomic variables such as real yields, currency strength, and risk sentiment. When cross-asset volatility rises, algorithms can reduce exposure across commodities simultaneously. Understanding this microstructure is essential for serious analysis. Without recognizing the role of automated trading and liquidity conditions, investors may misattribute price swings to shifts in physical supply-demand balance. Modern silver pricing operates within a high-speed, leveraged framework where technical triggers and capital flows frequently dominate short-term direction. So here's the real takeaway. Understanding silver pricing requires more than watching spot charts. It requires examining futures leverage, regulatory enforcement history, concentration data, and the mechanics of modern electronic markets. The silver market is not a simple supply and demand story. It is a financialized, highly leveraged derivatives ecosystem where institutional positioning can significantly influence price behavior in the short term. As investors and analysts, our responsibility is not to jump to conclusions, but to follow documented evidence, understand structural incentives, and interpret market data with discipline. Because in finance, the truth isn't hidden in rumors. It's hidden in the structure.